Datadog. Data, my hater. Welcome back to Strongman Personal Finance. This is a paid video where we're going to analyze Datadog stock. If you too want a paid video, you send me $50 and I'll make a video about whatever you want me to. Doesn't have to be about a stock, okay? Anyway, let's go dive right into this paid video and analyze the financial statements of Datadog Incorporated, DDOG. There's so many jokes that just come to my mind when I think about this company, but I'll keep that to myself, okay? Market cap, 30 billion. Revenue, 1.79 billion. So that's a price to sales of, oops, messed that up. That's a pretty expensive stock just on a price to sales metric, okay? Divided by 1.79. Price to sales of 16, okay. So for $1 of sales, you're paying $16. Net income, negative 83 million. Okay, that's a loss. Forward PE, 69.44. 69,420. And all the analysts say buy with a price target of 103. It's currently trading at $93. That's almost a 10x right there. What does Datadog do? They provide monitoring and analytics platform for developers, IT operations team, and business users in the cloud in North America and internationally. The company's software as a service platform integrates and automates infrastructure monitoring, application performance monitoring, log management. So basically, it helps you take a bunch of information, like stalking your employees and seeing what they're doing, and condensing it into readily accessible formats. That's what I get when I hear about this or when I look at this company. But here's their website. Okay, you can look around and see all the stuff they do. I'm not a tech person. I don't understand any of this crap. But apparently they provide a lot of software solutions. And it seems to be a very beneficial solution because a lot of people use it. Who uses Datadog? Samsung, 21st Century Fox, Shell, Siemens, Lufthansa. All these big companies use them. They have a lot of customers. Look at that. DraftKings, bearish, garbage. So if you want to read more about what the company actually does, you can go read their website. Okay, I'm not a tech person. I don't understand. When I read these websites, it just like melts my brain. Oh, blah, 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 software, blah, solution, software. I like to look at the numbers. That's what I care about. So let's go ahead and look at the stock price performance. So it looks like it's just recently started trading. When did it IPO? September 9th. Oh, that's a very special day. That's my birthday. Well, I wasn't born in 2019. Okay, but anyway. So it IPO'd before the clown market, thankfully. And then it's basically shot up massively during the clown market. And then it collapsed by about 50%. And now it went up again recently. Over the past 1 year, it's up 1.24%. And year to date, it's up 23%. Fascinating. Okay, let's go ahead and look at some of the metrics. So revenue by revenue is going up, but the growth rate is slowing down pretty significantly. You can see how the revenue each quarter goes up, but the percentage that it goes up is slower and slower. Year over year revenue growth rate is dropping pretty precipitously. Okay, that's still insanely high revenue growth. I mean, look at that. 75% quarter over quarter, then down to 50%, now at 32.69%. So they have very, very rapid revenue growth. And you would hope they would because they have a price to sales of like 16. You're paying $16 for $1 of revenue. Okay. So revenue is still growing pretty heftily, but it's slowing down pretty significantly. Let's look at some margins. How have the margins, my margins done? Gross profit is, I'd say, slightly improved over time, or at least stayed flat. It's gotten better. Operating margin, this company has lost money consistently except for a couple quarters. And they don't really seem to be improving. I mean, they had worse losses earlier in 2018, 2019, but they're still losing money. I wonder if they have a lot of stock-based compensation. I wonder, profit margin, if they have positive cash flow and they have a loss, it's probably stock-based compensation, okay? I see all these tech companies have stunk-based compensation. That's not a cost. It doesn't matter. Profit margins basically loses money. Oh, and they have a very strong free cash flow margin. What did I say, ladies? I guarantee you there's a huge amount of stock-based compensation. Every tech company, okay, it's just stunk-based compensation. Let's look at the shares, diluted shares outstanding. I mean, they haven't gone up a lot. Let's see, basic shares. Okay, so not a lot of dilution, but if the employees exercise their stock options, you're going to see some dilution. Yeah, lots of dilution. So overall, it's a rapidly growing company with revenue that doesn't make money, but has strong cash flow because they probably pay their employees in stock options. Balance sheet, we're going to skip it because that doesn't matter. No, I'm just kidding. It's because we'll look at it later. And we can see they have very strong and growing operating cash flow. Okay. Very, very strong. The trend for operating cash flow is up. And you can see that because when you pay your employees with stock instead of cash, you have a lot of cash left over. But when those employees exercise their stock options, that divides the remaining profit over the company over more people. And guess who pays for those stock options? Because you know what these companies also do? They give stock options to their employees. The employees buy the stock cheaply, and then the company buys back the stock at full price on the open market. Gotta love it. Yep. So they have very, very strong and growing cash flow. Capital expenditures. I mean, obviously they're spending more. They're definitely spending more in 2022 than the prior years. Nothing crazy though. So they have positive free cash flow. Okay. And, if you just go off free cash flow, okay, great. That's awesome. But they are definitely diluting to Kingdom Come, or they will be once people exercise their stock options. Let's look at ratios. So a PE ratio of negative 276, price to sales of almost 17. That's pretty rich. Price to book of 20, debt to equity ratio, flat. Current ratio, very hefty. I'm sure this company's doing fine. They have plenty of operating cash flow. I'd be shocked if this company was about to go bankrupt. Okay. Anyway, let's read some of the 10K. So the 10K came out. When did this come out? So this is the company's financials as of December 31st, 2022. The 10K is nice because it tells you about the business, the risk factors, blah, 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 blah. So if we skim the risk factors, let's see if there's anything crazy on here that jumps out to me immediately. Unfavorable conditions could hurt our company. Our recent rapid growth may not be indicative of future growth. That's true. That's why it's so hard to buy good stocks. We have a history of operating losses. They do, and may not achieve or sustain profitability in the future. Blah, 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 blah. Our business depends on customers, failure to achieve, blah, 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 interruptions, blah, blah, COVID-19, blah, 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 blah. The dual class structure of our common stock has the effect of concentrating voting control with holders of our Class B common stock, including our executive officers, directors, and their affiliates, which will limit the ability of holders of our Class A common stock to influence the outcome of important transactions. Okay, so I guess if you buy Class A stock, because you own the company, bro, you're not going to be able to influence anything. Okay, let's go ahead and jump to management's discussion and analysis. You know what's annoying about this report is it doesn't the links don't work. Like why? 45. All right, here we go. No. Okay, they're showing the stunk price. I don't care. Management's discussion and analysis. So this is the management giving you more information. You're going to see a lot of details here. Datadog is the observability and security platform for cloud applications. If you want to stock your employees, then you can go ahead and use Datadog. That's what I mean. I don't know if they do that, to be honest, but okay. So here they're shilling their revenue growth. Their revenue by revenue is going up. I get it. They have strong operating cash flows, yes, because they have a lot of stock-based compensation. It's very predictable. Acquiring new customers. We believe there's substantial opportunity to continue to grow our customer base. We intend to drive blah, 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 blah. As of December 31st, 2022, we had approximately 23,200 customers compared to 18,800 as of December. So year over year, they've grown their customer count. Let's see. By 23%. And we compare that to revenue. Let's see how fast their revenue grew year over year. Okay, so basically they acquired the customers that they acquired, they're getting more money, it looks like, because their customer count grew at a slower pace than their revenue growth pretty significantly. So that's actually good. They're generating a ton of revenue from customers, from new customers, or they're getting a lot of revenue from old customers. I mean, that's another good thing. But their revenue growth rate has definitely outstripped their customer growth rate. Let's see. Customers exclude customers from a recent acquisition, which did not contribute meaningful revenue. Okay, that doesn't matter. Let's see. Expanding within our existing customer base. Our base of customers represents a significant opportunity for further sales expansion. As of December 31st, 2022, we had approximately 2,780 customers with annual run rate revenue of $100,000 or more. So they're very diversified. They have a pretty broad customer base, representing 85% of our annual run rate, up from 2,000 in December 30th, representing 83. Blah, 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 blah. As a further indication of the propensity of our customer relationships to expand over time, as of each December 31st, our dollar-based net retention rate was above 130%. Okay, so they're keeping their customers and they're getting a lot of money from them. And they're getting more money from them. And that's obvious because their revenue is growing faster than their customers. So customers are using it and they're liking it. That's what I get from this company, which is good. Okay. Expanding internationally. International's bad because it didn't go up as much as U.S. stocks. Buy things that go up a lot. All these investments beyond. We now have sales presence internationally in Amsterdam, Dublin, London, Paris, Seoul, my butthole, Singapore, Sydney, and Tokyo. Okay. Very interesting. Let's see. Okay, so they have revenue. Obviously, we know their revenue is growing up. Let's see what's hurting their margins. Obviously, R&D looks like one of their biggest expenses. By and far, R&D is one of their biggest expenses. Now, and I wonder how much stock-based compensation is being allocated to that. So R&D for the last year was 45% of revenues. And the prior year, it was 40%. So they are more and more percentage of their revenues is going into research and development. Sales and marketing looks like it went up pretty significantly. For 2022, sales and marketing was 30% of their revenues. And in the prior year, it was, let's see, marketing. What a scam. Was 9%. So they're spending more on marketing, way more on marketing, and they're spending more on research and development. Okay. I mean, I can totally, this company's definitely going to be profitable in the future, obviously. Okay. Let's see how much their stock-based compensation comes into play. Well, a big part of their research and development is stock-based compensation. So the stock-based compensation expense is reflected in the financial statements. I don't think people like Joseph Carlson understand that. This is on the accrual basis of accounting. Stock-based compensation is contained within each one of these. So when you see a lot of expenses going up, a lot of that is from stock-based compensation. And at some point, the stock-based compensation will end unless they keep giving out more and more stock. And it ends because once the options vest, they completely vest, the vesting period is over, that's when the expense stops. That's why you eventually see a precipitous drop in stock-based compensation unless they keep giving out more and more and more in the future. So you kind of have to monitor what they've given out and what they plan to give out or what they say they're going to give out in the future. But yeah, a huge part of their revenues is stock-based compensation. That's pretty typical. Operating losses, obviously, their margins aren't getting better. Big part of which is stock-based compensation. Interest expense has gone down. Interest income has gone up. So their profit margin is a little bit better than their operating margin, and that's because of interest income. So you'll see a difference there. But overall, obviously they're not making money and they're diluting the shareholders. That's just, you kind of have to judge it for yourself, whether you want to invest in a company that saves cash by giving out shares. Okay, let's continue. Interest expense. Oh, they did an analysis right here. This makes it easier. See how great management's discussion analysis. So this is called vertical analysis. Basically, they calculate each line item as a percentage of revenue, so you can see trends, okay? For example, we see revenue is 100% of revenue. Cost of revenue is the percentage of revenue that is taken up by cost of sales. So their gross profit has actually gotten a little bit better. They're spending a ton of money on R&D. Sales and marketing went up a blip. General and admin went down a little bit. Okay. And their net loss was 3% versus an operating loss of 4%. So they're almost profitable. And when that stock-based compensation runs out, and hopefully they don't keep giving out more stock options, okay, then at that point, you're going to see some profits. Okay, I think this company will be profitable in the future, no doubt in my mind. When that'll be, I have no idea. Okay. Sales and marketing. Let's see. Let's see. Okay, they're just giving a lot of detail into the different accounts, which is great. This is really good. Okay. You know, they have cash flow. So we'll look at their statement of cash flows. But overall, like, you know, I can't like hate on the company too much. I mean, yeah, they're diluting. This is basically like Palantir if Palantir actually had good revenue growth. Typical software company. Okay, the auditor's report. Let's see. We have audited. The financial statements present fairly in all material respects. That's good. Audit's good. Okay, let's look at the balance sheet. Cash has gone up. Marketable securities has gone up. So they're parking a lot of cash. They're sitting on a lot of cash here. Okay, they got $1.5 billion sitting in marketable securities. So you're going to see interest income, but you shouldn't really factor that into the fundamental company's analysis. Interest rates are up. They're going to generate more interest income. But if you're looking at the fundamental business, the income from this is not part of the fundamental business. Okay, that's why operating income, you should probably focus on that a little bit more. For this company, at least. But yeah, they have no problems with cash or marketable securities. Accounts receivable is up. Obviously, their sales are going up pretty significantly. So their receivables are going to go up. Deferred contract costs, really no crazy change. Prepaid expenses. So overall, I mean, they're sitting nice. Their balance sheet looks good so far. So if we compare total current assets to total current liabilities, they have a very good current ratio. And if you look, the vast majority of their liabilities is deferred revenue. This company's balance sheet is extremely solid. I can just tell you that. Just looking, like, this company is not going to go bankrupt anytime soon. They're making a lot of money. Cash-wise. Profit-wise, if you factor in stock-based compensation, they're not. But cash-wise, they're fine. Okay? Let's see what's going on here. Property and equipment went up. Okay, they're buying more equipment, more leases. Goodwill went up. They had some kind of acquisition. But even if the goodwill gets 100% impaired, what is there? That still wouldn't wipe out the stockholders' equity. So, but they did do an acquisition. Deferred contract costs, restricted cash. Okay. Like, I got nothing bad to say about this company's balance sheet. A big part of their, let's see, operating leases, convertible senior notes. They got some debt. They got some debt there. Nothing crazy, though. Deferred revenue non-current is lower. That's interesting. So their deferred revenue current went up a lot more, but their non-current revenue, which is revenue they've been paid in advance before they've actually provided the service, is actually down. So I don't know what that portends. Maybe that means nothing, but I would expect deferred revenue to go up. Deferred revenue non-current long-term to go up faster than or more than the prior year if they have growing revenue. So I don't know if that indicates a revenue slowdown or what, but that's something that I can see right there. I mean, it's not nothing crazy. Okay. This company's fine. I mean, obviously their balance sheet, they're completely capitalized by their stockholders' equity is completely composed of stock issuance. That's where all their equities come from. Okay. So let's go. Okay, we've already seen the income statement. We see shares outstanding have gone up by 309,048. 2%. Wait till employees exercise their stock options. Okay. Blah, 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 blah. Okay, statement of stockholders' equity. So what I'm curious about is stock-based compensation. How many shares of stock have they given out through stock-based compensation? Okay, so for the year from December 31st, 2022 to 2021, these are the numbers of stock that were given out. Issuance of stock under employee stock purchase plan, 316,000. Issuance of restricted shares of common stock from acquisition. So they use some stock for an acquisition. Vesting of restricted stock units, 2.5 million. Woo, baby. All their stock is coming from stock options. Yeah. Okay. Makes sense. What a shocker. Cash flows from operations. Okay. Look at that stunk-based compensation. Woo, baby. I'm just looking to see if there's anything crazy here. Accounts receivable. Try to see if there's anything crazy year over year that changed. Really? No. A lot. I mean, basically, their profit is worse because of stock-based compensation, but their cash flow is doing fine, massively fine. They're doing fine. Let's see. Purchases of PP&E, capitalized software costs. Okay, they've definitely slowed down acquisitions. They paid $45 million for an acquisition. And they generated a little bit of cash from their employees exercising stock options. So overall, like the company, it's doing fine. Like the balance sheet is fine. The balance sheet is very, very healthy. Very, very healthy. The thing with this company is its valuation is just richly valued. I mean, like that's with all these stocks, all these large tech or medium-sized or any kind of tech company. The ratios. Look at this price to sales. That's pricey. That's a pricey price to sales. Price to books. It's a big number. Okay, so you got to hope that the projections that the market is building into this stock match the reality. How's the stock done again? I forgot. Let's see. Overall, it's gone up 100. I mean, honestly, I can't hate the company too much. It reminds me of Palantir very significantly. Okay. Basically the same gross margin as Palantir. It's just, they're not that similar, obviously, but same gross margin, a lot of stock-based compensation, significant revenue growth. But the rate is slowing down. Not bad. This is their this is their most recent quarterly statement. Try to see if there's anything crazy that's going on here. Cash flow. Let's see. Yep, there's more stock going out, obviously because of stock-based compensation, but they still have healthy cash flow. What else did they do? Yeah, I don't know. I don't know what else to say. I kind of broke it down like I could, as well as I could. Yeah, most of their marketable securities are in commercial debt securities. Wonder what that is. Commercial debt securities. Other companies' debts. Now, I would like to see my companies have their money in all treasuries, okay? Treasuries are risk-free. I don't know what these commercial debt securities are. Maybe you want to look into that a little bit and see what they mean by that. Maybe it's a corporate debt. There you go. Corporate debt. They put up a lot of their money in corporate debt. They're yield chasing. A bunch of clowns. Hopefully it's high-quality corporate debt. Let's see. Yeah. That's the main things. I don't know. Do you guys have any questions? Let's see. If you want your own personalized video, send me money. Gave up roasting Palantir. No. I talk about it at every earnings. I'm not going to talk about it every day. Do you invest in crypto? No, I don't. Goes from Palantir to Datadog after Palantir rips 100%. It went down massively, but it went up a little bit, so I proved you wrong. I paid for this. Woo, baby. Great job. Thank you, sir. Thank you. Let's see. Stares at Meta announcing a buyback for more money than they have on hand. Well, they're not going to buy it all back at once. Come on. You better respect data. I can't crap on it. Obviously, I've laid out the company as best as I can from an accountant's perspective. Kid Freshman told me to tell you not to do valuations on stocks. Okay, Benjamar. Strong man, I'm 21. Around age would you consider transitioning some percent of your VT into bonds? Depends when you're going to retire. That's the real question. I don't have any bonds yet, but I'm not retiring for probably like 20, 30 years. Just, it depends on your age. Have you seen penalty? Penalty! Penalty! Bud Light stock. Bud Light stock. I don't care about it. Having companies like Meta Alphabet become highly, highly profitable despite very high stock-based compensation. Why don't you ever talk about? No, I mean, Datadog, if they slow down their stock-based compensation 100%, 100%, they would be more profitable. Unless their employees demanded higher wages. Then that would hurt their cash flow a little bit. 30%. Yeah, they're spending a lot of money on R&D and marketing. I can tell you that. But if they obviously they could slow that down and become very profitable. And a big part of that expense is the stock-based compensation. It's allocated to the different accounts because the employees that work in marketing, they have been given stock options, and the cost of those stock options of that employee that works in marketing is expensed out as marketing expense because it's part of the employee's wages. Sup, brokies? Big ups, pimps, shout out to the hoodlums. Make enough money you don't care about boring stocks or retirement. There's a concept of refreshers that applies to restricted stock. I'm sure you cannot name a company that stopped refreshers all of a sudden. What does that mean? Shawman, do you think the U.S. we're not going to default? Biden ruled out 14A. McCarthy said they need to deal, but Rogan's it's all BS. Ignore that garbage. Okay. You know how many times I've heard the debt ceiling? My whole life I've heard it. Nothing bad ever happens. It's a stupid joke. Incoming QQQ crash with NVIDIA earnings tomorrow. Good. Maybe I'll look stupid. 10x. No, yeah, it's not going to default. Let's see. Palantir's trash. The next Enron. But this is a company where I lost money, even though during the clown market, because I got in at the wrong time. That's true. You got to get in at the wrong time. $1 billion payment to CEO, Black Box, Palantir. What about Moat, the ETF? I don't know. Maybe I should do a paid video for that, huh? Why doesn't somebody cough up some money and I'll do the Moat ETF? Richly valued, kid fresh, he should be rolling in his grade. Great, okay. How is Strongman's investment in Crocs? All that revenue, my avenue, LOL. All right, guys, that's Datadog for you. If you want your own personalized video, click that link, send me $50, and I'll make you a video. Talk to you later. Cheers.